when we have an event, and I would call tariffs an event which destroys value, everything has to go down. That includes gold and silver, and we did see that in the early stage of the event. Stock markets, if you look at NASDAQ now, it's down 20%, and the Dow Jones or the S&P 500 is down, I don't know, 14 or something percent. But how much is gold down? It's like probably less than 1% at the moment. So gold is holding up very, very well. I mean, it did have its dip, but it recovered fairly rapidly. And I think what's going on here is that there are big buyers out there somewhere who are saying we're going to have some allocation or more allocation to gold than we had before. Whether that's central banks or private individuals, or maybe it's a big country, perhaps. I mean, I'm going to throw one out there.
Clive Thompson, respected macro analyst and investor, just delivered a blunt take on tariffs and gold. And the message is clear. When tariffs hit, everything takes a hit, at least at first. Markets cracked. The NASDAQ was down 20%, and the S&P 500 nearly 14%. But gold, barely down 1% and already rebounding. Thompson believes big institutional players, maybe even central banks, are reallocating into gold for stability. Why? Because gold is now improving portfolio Sharpe ratios across the board. It lowers volatility and boosts returns, catching the attention of major allocators. Meanwhile, tariffs are a slow-moving wrecking ball. Jobs will vanish, profits will fall, and recession odds are rising globally. Supply chains are fracturing, and inflation, though temporary, will bite hard. Now, we present the latest clips of Clive Thompson's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
As for gold and silver, a lot of we've seen how well it's held up in this recent market debacle. It's almost down nothing. And I think that asset allocators are now looking at their portfolios. They're saying, as they do all the time, they're back testing the different asset allocations, and they're discovering, when they do these back tests now, they're discovering that had they had some gold in the portfolio, it would have improved what's called the Sharpe ratio. The Sharpe ratio is a measure of risk and reward. You want to have the Sharpe ratio at the best level. So they'll find that adding gold to the portfolio will have improved the Sharpe ratio. It will, in other words, it will have reduced the volatility, and it will have increased the return.
Right.
So what's going to happen? Portfolio allocators will start to add a little bit of gold to portfolios going forward, and it won't take a lot of gold. There are people whose jobs must be at risk. And these people probably need to be conserving cash in case they fall on hard times due to their job will be at risk, because when companies' sales reduce, it's only a question of time before they start to cut back on the staff, maybe 10% less staff. And you never know if you're going to be one of them. So those sort of people whose jobs might be at risk need to be conserving cash so that they can see themselves through a rainy day until they get another job. But there will also be those people who've got a lot of surplus wealth, and now we're going into recession. Well, what should they do? Are they going to have an opportunity to buy things more cheaply? Can they buy equities more cheaply? Can they buy business more cheaply? Can they buy property more cheaply? Can they buy gold more cheaply? This is a question. I mean, I think the way things go, we're seeing central banks buying more gold than ever, and the central banks literally do not care what is. Central banks are saying, look what's going on with the tariffs. Look what's going on with Mr. Trump. We don't know which way he's going to jump. We have been friends with the United States, and we still are friends with the United States. But now they're talking about maybe giving us 100-year bonds at low interest rates in place of the 10-year treasuries we've got. And we might find that we've got no choice but to accede to that if we want to continue to keep our friendship with the United States. Right. It might be pushed on us. So the need to have more treasuries, I think, is falling away, and the need to have something else, and obviously it's gold, is going up. So I think that probably gold is well supported around these levels. Yeah, whether it's the sort of 3,000 level or 3,000 or 2,500 level, or maybe it'll turn out to be a lot higher. I think it's well supported. So the risk is in my opinion less than, for example, holding equities where there's a long way down if they want to go down. I'm hoping, and I don't expect that we'll go into some sort of Great Depression. I do think we're going to see globally higher prices. I think central banks are going to look at those and say that's a one-off. It's not part of the underlying inflation, so it has to be disregarded. So we won't take into account the rising prices as part of our policy of keeping inflation down, because in a year's time, this one-off impact of higher tariffs and so forth will be out of the system. So, but obviously we are going to have all around the world, people will lose their jobs due to the tariffs at both ends, both due to the American tariffs on foreign goods and the retaliations by foreign countries. I did a little calculation last night. I spent a long time of it. Switzerland, which is one of the many countries which has been accused of having a trade imbalance with the United States, I looked at the numbers. Switzerland is supporting slightly over 1 million jobs in the United States through its imports and its services, which it buys from the United States.
Okay.
And the United States is supporting. So USA has more jobs supported by Switzerland than Switzerland has supported by the USA. Yet I'm looking at that number, and where Switzerland is being accused of having a huge trade imbalance. But of course, what they're looking at is the imbalance in physical goods, because in fact, it's true that America buys more physical Swiss goods than Switzerland buys physical American goods. But when you look at the services industry, Switzerland buys a lot more services out of the United States than America buys from Switzerland. So now Switzerland hasn't imposed any retaliatory tariffs, but certainly it does mean that, and I take our country as an example, Switzerland, it does mean that some people are going to lose their jobs here because America will be importing less than they used to. And that applies to just about every country in the world. People in America are not going to pay higher prices if they don't have to. So they'll be looking around and seeing where they can buy, if there is a competing American product, they'll be looking around trying to find out where they can buy that competing product. And, that might come, and probably will come in some cases, from an American manufacturer. So yes, internally, it's going to be good for America up to a point, because some American businesses will be able to put up their prices because the demand will suddenly increase. But other American businesses will suffer greatly because most of what they make is imported from abroad.
Right.
So if you're manufacturing, if you're in the motor car industry or building computers or anything, you're buying components and stuff, or tractors, doesn't matter. Whatever you're buying components from all around the world. And as they come into the United States, they're going to cost you, the importer, a lot more. And that means that your profits will shrink, and some businesses will go out of business and some will report lower profits. And there'll be very, very few who will report higher profits because they make everything inside the United States, and the competing foreign product isn't coming in quite as much. So I think in a way we go to a situation where overall prices will rise, and over time people will lose their jobs. The unemployment rate, I think, will rise because of this, not only in the United States but globally, and that basically means we'll go into some sort of recession, and we'll see lower profits from companies around the world, and that will mean most likely lower equity prices for a while.
Thompson sees a recession ahead, not a collapse, but a global cool-down with persistent job losses and higher prices. For businesses relying on imported components, profit margins will compress fast. The risks to equities are still substantial. But gold, strong hands are buying. Central banks don't care about price, they just care about protection. The US may benefit short-term from reshoring, but inflation and retaliation are global threats. Thompson's bottom line: gold is quietly becoming the safe harbor, even as portfolios get stress-tested by policy shocks. Share your thoughts on Clive Thompson's analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.